I had a question recently about a metric called yield on cost, aka return on cost, and sometimes also called development yield. So, what is it, and when and how might it be useful? Yield on cost is very similar to cap rate, which you're already familiar with, especially if you followed my posts, read my books, or taken my online course. It's a metric commonly used by investors and commercial appraisers, and it's the ratio of a property's net operating income to its market value. It looks at an income property at a point in time. So what's the difference between cap rate and yield on cost? Well, cap rate measures income in relation to the value of a property, but yield on cost measures income in relation to the total cost of the property. Another way to think of yield on cost is as a forward-looking cap rate. Okay, let's try to make some sense of this by hanging some numbers on these words. You decide to buy a property today with its $50,000 NOI at the market cap rate of 5%. So you decide to buy it for $1 million. But you see a value-add opportunity here to make some improvements and to create value. You're going to spend money to make money. Specifically, you're going to upgrade these apartments and raise the rents. Remember, value-add is an opportunistic approach to investing. You're looking for a better return, and almost by definition, higher return implies greater risk. So you want to try to get a quick read on whether that higher return, in your judgment, is going to be worth the greater risk. So you're thinking of spending $75,000 on improvements so that you can bump up rents by 15%. Let's see how that looks. Okay, you can see here, original purchase price of $1 million, plus improvements of $75,000 gives you a total cost of $1,075,000. Your original NOI was $50,000. A 15% increase would be another $7,500. So your stabilized NOI after improvements would be $57,500. Now let's use the yield on cost formula, which is basically just a lot like the cap rate formula. You see it here. YOC equals stabilized NOI divided by total cost. So with our example, YOC equals $57,500 divided by $1,075,000, or 5.35%. I believe you'll see right away how this is just slightly different from the standard cap rate formula. With YOC, you're using the NOI as it is stabilized after you make the improvements. And you're using the total amount the property cost you, rather than what you think it might be worth. Again, cost, not value. Okay, so you see your yield on cost is higher than the 5% market cap rate, and that's what you want. You want a so-called spread between the return on cost and the market cap rate for your value-add scenario. That spread here is about 0.35%. The question that only you can answer is that spread worth the risk? One way that might help you to decide is to see, what do you think the property is going to be worth after these improvements? For that, you'd probably cycle back to the cap rate formula, because that deals with value as a function of income. You'll use the market cap rate of 5% with your new stabilized NOI. So as you see here, value equals NOI over cap rate. Value equals $57,500, that's the stabilized NOI, divided by the market cap of 5%, for a value of $1,150,000. So its value now after the improvements is $1.15 million, which is, as you'll notice, $75,000 more than your total cost. The math here is probably simpler than the decision itself. That decision rests on your subjective evaluation of the risk involved. How confident are you that you can raise the rents by 15% after spending those $75,000 on improvements? In other words, you've calculated the potential reward objectively. Now you must weigh that against the risks which you measure pretty much subjectively. So, to wrap things up, yield on cost is similar to cap rate, except it measures stabilized net operating income after improvements, and measures them against total property cost. It does that rather than weighing the current NOI against current property value, which is what you're doing with regular cap rate. Yield on cost is extremely easy to calculate, and it can be useful with value-add investments to get a sense for how improvements to a property will impact your return. And it should also give you a sense as to whether the additional return is worth the risk. Yield on cost is often used by developers, too, for a quick read on potential projects. So look for more about this metric in a new lesson I'm adding to my course, Introduction to Real Estate Investment Analysis.